All right, welcome to this explainer. Today, we're diving deep into Costco's business model to figure out if the warehouse giant is actually a smart stock to buy right now. I mean, it's the retailer that millions of people around the world literally cannot seem to live without. But as we know, a genuinely great business doesn't always equal a great stock at any price.
So let's start with the million-dollar question and really set the stakes for why investors are so intensely divided on buying in at such a massively high valuation. We're going to look under the hood of the business, unpack the recent numbers, tackle that valuation head-on, and explore exactly what Wall Street is saying so you can make sense of this whole debate.
Okay, Section 1, the membership disguise, because they really aren't just another retailer.
To really understand the stock, we first have to peel back the layers. Look, traditional competitors like Walmart or Target, they're typically relying on marking up products by, 20 to 30%. But Costco, they operate almost in reverse. They cap their markups at a strict 14%, and they do this to prioritize membership signups. They aren't actually trying to make their real money off the items sitting in your shopping cart. Those insanely good deals, like that famously untouchable $1.50 hot dog combo, are really just the magnet. They get you in the door to buy the actual product, which is the membership itself.
And man, that strategy pays off. It results in an absolutely staggering 92.2% North American membership renewal rate. Globally, it's over 90%. This showcases a level of customer loyalty that most brands can literally only dream of. Once people enter the Costco ecosystem, they simply do not leave. It's kind of like a highly addictive streaming service, but, for bulk paper towels and rotisserie chickens.
And here's the profit math that makes it all work. In fiscal 2025, Costco collected roughly $4.7 billion in nearly guaranteed membership fees. Because of how the business is structured, almost all of that money drops straight to the bottom line. It effectively makes Costco a subscription company that just happens to sell groceries. To put that into perspective, that is more than the entire net income of a lot of Fortune 500 companies. Predictable, recurring revenue commands a huge premium on Wall Street, and this right here is the engine driving it.
Moving on to Section 2, by the numbers. Let's look at the fiscal Q3 2026 results.
So, they successfully beat Wall Street estimates with $70.53 billion in total revenue. That's a solid 11.6% increase year over year. Same-store sales, which is an absolutely critical metric for any retailer, grew by 6.6%, and earnings per share came in at $5.19. But honestly, the real standout metric? A massive 37% jump in e-commerce sales. For a company that's traditionally relied so heavily on that in-store treasure hunt kind of experience, they're finally getting their digital act together, and it's opening up an entirely new, massive growth channel.
They're also rewarding their long-term shareholders really nicely. Back in April 2026, they raised the regular dividend by 13% to $1.47 per share. Now, while the current yield is quite modest, we're talking about 0.6%. The real story for investors is their highly lucrative history of special dividends. I mean, for instance, they paid out a whopping $15 per share bonus in 2024. Not too shabby, right?
Which brings us to Section 3, the valuation elephant, also known as the priced for perfection problem. We've seen the phenomenal business model, and the numbers are great, but now we really have to confront the massive plot twist of this whole explainer, the incredibly high price tag attached to the stock. To really see the premium investors are paying, just look at the broader S&P 500, which trades at about 21 times earnings. Walmart sits at roughly 31 times. But Costco? A staggering 48 times earnings. You are basically paying $48 for every $1 of Costco's annual profits.
That extremely high multiple brings us to a critical concept in investing, priced for perfection. It creates a really dangerous, no margin for error reality for investors, because the multiple is just so high. Even if Costco continues to grow its earnings at its current 13% annual rate, it would still take over 6 years just to mathematically justify its current price. Any slight disappointment, it gets punished, and severely.
And we actually saw this exact scenario play out in real time recently. The stock dropped 4% after Q3 earnings were announced. And remember, they beat estimates. So why did it drop? Simply because their earnings beat wasn't large enough to justify the sheer perfection already priced into the stock by the market.
All right, Section 4, bulls versus bears. Let's weigh the arguments.
Since the stock has pulled back about 8.5% over the last 3 months, slightly easing that valuation, let's impartially break down the current debate between the market optimists and the skeptics. First up, the bull case. The bulls confidently argue that the business quality absolutely justifies that premium price tag. They point to best-in-class metrics, like a 29% return on equity and a 22% return on invested capital. Plus, they see a massive international expansion runway waiting over in China and Europe. Add to that the fact that executive members spend 3 times more than regular members, and you've got an embedded growth lever that doesn't even require opening new stores.
However, let's flip over to the bear case. The bears counter that a 48x multiple just implies an unrealistic level of perfection. They're quick to warn that comparable sales growth is already slowing down to a more modest 6.6%, at least compared to those double-digit pandemic years. And perhaps most importantly, they highlight that the stock has actually underperformed the broader market so far in 2026, returning 11.5% versus the S&P's 13.7%. They ask a pretty great question. If the stock can't outperform when the business is doing well, what exactly happens when consumer spending tanks?
Which leads us to Section 5, Wall Street's verdict. Let's look at analyst price targets and consensus.
So with these two highly compelling arguments on the table, how are major Wall Street analysts currently placing their bets? Well, despite the heavy valuation concerns leading to hold ratings from firms like Truist and Guggenheim, the overall consensus remains overwhelmingly bullish. The average target sits at $1,077, which implies about a 12% upside from current levels. Some firms like Bank of America and Bernstein are setting their sights even higher, right near the $1,200 mark.
So what's the bottom line here? Look, while the business itself is undeniably exceptional, boasting incredible loyalty and financial discipline that will very likely thrive for the next 10 to 20 years, the stock price still matters. For new investors, patience might just be the best strategy right now. Waiting for a pullback to the $800 to $850 range could offer a much more attractive entry point than buying at today's absolute peak expectations.
I'll leave you with this final, provocative thought to consider for your own portfolio. Are you buying Costco stock at these current levels, or are you waiting for a better price? Are you willing to pay for absolute perfection today, or are you holding out for a discount tomorrow? Understanding exactly how a company's underlying business mechanics interact with its market valuation is really the key to mastering your own investment journey. Keep learning, keep analyzing, and thanks for joining this explainer.